It's time to talk taxes.
New friends, new opportunities, new partners. EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hey everybody, this is the Tax Lady, and we're going to talk taxes. We're getting close to that time of year, you know, when the 2023 is going to kind of fold up and 2024 is going to be rolling out. We just want to make sure you know so that you can take advantage of many of the new changes in the tax law. And of course, I'm joined in studio with Tiffany Fabian. Hey, Tiff.
Hey, happy Saturday.
Happy Saturday to you, and Christopher Fabian.
Hello, Esther.
Hey, Chris. So I wanted to say thank you so much to the financial guys for hosting the Ready, Set, Retired seminar. We grew out of our corporate headquarters. We had to change some of the space that we used to hold the seminar at into private offices. So the guys stepped up, and boy, we really appreciate it. And it was a great success.
Yeah, what a nice facility. And they did such a great job accommodating everybody. And they used a similar format that we have grown accustomed to, and it works really well and it runs really smooth. It's sort of like a little sampling and you get to meet everybody. I was with somebody today and they're getting ready to retire and they didn't know about the essential plan. So by coming there today, they learned. They saved hundreds of dollars instead of using, Cobra or something similar.
Well, I will tell you, this is open enrollment, and if you're somebody that needs help with your health insurance, it's a free service that is provided by the insurance companies to help you to get the best plan. And we have a specialist right in our office, right?
We do. We have Chris Moody. He's there every Tuesday and Thursday at our office, at the financial guy's office on Monday, Wednesday, and Friday. But, yep, you can call us, call them to get that. I mean, it's just a way you can save money without even realizing that's an option.
And they also, it's also the best fit, because his job is to make sure that your needs are reflected in the insurance that he suggests, right?
Right. Yep. They shop all the subscribers,
the people,
the
insurance companies.
Right.
Instead, if you just go to a Blue Cross Blue Shield seminar, they're only going to tell you about Blue Cross Blue Shield. You go to Univera, they're only going to tell you about Univera. Same thing with
and then you got to compare them all.
Right. Here you get it all in one place, one sitting, and they can get you set up the right way and for the least amount. And
you know, a lot of people think I've when I do tax returns, and I'll say, "And you have? Did you get?" You have health insurance, and they'll say, no, I don't. I can't afford it because my income's too low. Actually, in New York State, with the New York State of Health, the poorer you are, the more you get from them, and you'll end up not paying anything at all in many cases. But again, ignorance is not bliss.
No.
Because you can really shoot yourself in the foot. So if you don't know, if you think you can't afford it, you're the prime candidate to talk to these guys, because you really want the help, because to not have health insurance is terrible.
Yeah, that's the number one issue when people retire or retire early, that they don't have Medicare. What to do about their health insurance. Very important.
Right. I'm Esther Gulius, the tax lady from EG Tax, 803-0930, 803-0930, star 930 on a cell phone. You can text us at 716-803-0930. And while, of course, I ask the tax lady questions, and I just got one in a little while ago, and I thought it was interesting. This couple has Social Security of around $46,000. And they would like to take some money out of their IRA, and they think they're going to have to pay 20%. But the interesting thing is, when you do the math, half of their Social Security is $21,000. If they took $25,000 out of their IRA, that means their potential Social Security taxability equivalent would be 46,000. You subtract that from 32,000, which is the floor, which means only 14,000 of the Social Security is taxable. You add that to the 25,000 they take out of their IRA. So all they would pay in taxes, taking 25,000 out, isn't 20%, is $850. And if they did any energy conservation to their house, they'd get a credit and pay nothing.
Yeah.
And that's what people don't know is the standard deduction for seniors is $30,500. You don't pay taxes until your taxable income, your adjusted gross income, after your standard deduction exceeds your standard deduction exceeds the $30,500, and then it's only taxed at 10%.
Right?
Yeah.
Yep. I mean, it to your. I mean, I had a lady today. She was trying to protect what assets she did from a nursing home, and she had $65,000 roughly in an IRA, and I said, unfortunately, there's really nothing. And then I'm like, wait a minute, what's your income? She said, Social Security. I said, take out $12,000 a year out of your IRA, and you could gift it to your son. He can put it in a bank account for you, but not in your name, in his name. And after 5 years, that's protected. Do it again in January, then that amount is protected.
Right. So that's 24,000 really within 2 months.
Yeah,
right?
I told her
November, December, January.
Yep, I said, see, you don't have to be Donald Trump to have a loophole. You have a loophole.
Well, and so in this example that I just gave, where they could take 25,000 out and potentially pay zero in taxes, but the next 20,000 taxable income, 22,000, would only be taxed at 10%. Then the next $67,450 is only taxed at 12%. So it only goes up 2%. So you think about this, somebody could have like $89,000 in adjusted gross income and still be in the 12% tax bracket.
Yeah.
And that's really important for planning.
Exactly.
All right? I'm Esther Golias, the tax lady, 8030930, 8030930, star 930 on a cell phone, and you can text us at 716-8030930. And we got Mike. Hi, Mike.
Hello.
How are you?
A couple years ago, my wife's uncle passed away, and he left in his will a 5-year small monthly annuity. Okay. Up to the last 2 years, nothing was taxed. Now, each month, recently, there's a withholding tax from federal. I mean, did the law change? Is that taxable now, or why did they put a withholding tax on it?
All right, it could be that they sent you a form that said verify the Social Security number on this account, because this sounds like they've done backup withholding. So when you do the tax return, if there was withholding, that's going to be a credit that you're going to be able to apply as a payment that you made to the Internal Revenue Service, and you'll get it back. But the easiest way to make sure is to contact the financial institution and say, gee, you're taking out withholding. Why? And usually, and you guys correct me if I'm wrong, usually it's a problem with the non-verified Social Security number.
It could be, but it also could be the annuity finally had growth because the interest rates went up.
Well, we're talking about like $800 a month, okay? And like for 2 years, and she called them, and they said they didn't know why. They said, well, you can opt out. That's all they told her.
But she can opt out. So there's options. So first of all, if it was backup withholding, you give them the information. If you don't want withholding, because you said it's only $800 a month, stop the withholding. You can just change the W-4P, and they'll stop withholding. So those are things. And if you need help, you can call us. We'll help you to walk through the form.
But the law hasn't changed, though. It's not taxable, right? Still.
Well, it depends on all your other income.
Right.
Well,
right.
we're talking about AGI about $43,000.
Okay. Was she single?
No.
No, their income is $43,000.
All right. Your income's $43,000. From what sources, Mike?
Part Social Security and part pension.
All right. So how much is the pension?
Oh, roughly, I would say maybe 40. No, not 40. About 35.
Wait. How much do you get a month from your pension?
Well, combined maybe about something like 2,500 or something like that.
That's your pension, not your Social Security, right?
Right.
Okay, so that's 30,000, and the rest would be your Social Security?
Yes.
And over and above that, the $9,600 from that annuity?
No other income?
No other. Well, minimum for. Well, you know what?
Okay, well, first of all,
maybe about 900 a month for.
okay, but here's the other thing on an annuity. There could be a cost basis. So even though you're getting that $800 a month from the annuity, not all of it might be taxable as well. So, but it sounds to me like you'll definitely, if you have any income that's going to be taxable, it'll be a very small amount. But why don't you call us at the office? There's no charge. The phone number is 632-7886, so we can go over each thing specifically so that you know how to plan.
Yeah, because usually on an annuity, it's just the growth that's taxable.
Right.
Okay, thank you.
All right, you're welcome. Yeah, and so in an IRA, when it was a traditional IRA, all the money that comes out of a traditional IRA is fully taxable. In an annuity, there's usually a cost basis. Like, let's say grandma has 50,000 and she puts 50,000 in her annuity, and then upon her death it might have gone up to 70,000. So there's 20,000 in growth. Even though they get 70, only 20,000 of it's taxable because she had paid taxes on the original investment. So only the growth is taxable, and so that's why I didn't want to mislead
and then
him.
we should also tell Mike that the law hasn't changed on that. He had asked
No,
about
it
that.
hasn't.
No,
it has not. All right. So I'm Esther Golias, the tax lady from EG Tax, 8030930, 8030930, star 930 on the cell phone. Text us at 716-8030930. We're going to take a short break, and we'll be back on the other side with your questions, comments, and texts.
We are family. I got all my sisters with me.
Hey, I'm Esther Golias, the tax lady from EG Tax. We sure want to help you. We want to make sure that if there is a loophole out there, or a better way to take the money, or a better way to invest the money, or whatever that can help you, we want you to know. And you should never feel weird if you are not our client. You can call us up. You can go online to egtax.com, ask the tax lady, ask your questions. And just like this couple here that I helped this morning, I'd love to help you. We'd love to help you. Right, guys?
Yep.
For
Got
sure.
that right.
Oh, it sounds like Tiff went to Timbuktu.
Mike's on now.
All right. We have a text, right, Tiff?
We do. It says, what is the standard deduction for married filing joint when both are over the age of 65 and 23?
This year it's $30,500. I mean, that's a lot.
It is.
You
And then
think
the
about
following
that.
year.
Because that's over and in most cases, that's over and above your Social Security, or it goes into the mix. But after you come up with your taxable income, then you subtract $30,500 from it. And then after that, you apply the credits. So if you're doing any insulation to your home, you won't have to pay any taxes.
Yeah, and the year after 24, so that's 25, the Trump changes go away if they're not reinstated. So people have to watch out. The standard deductions will really drop.
Well, okay.
Yeah.
I
We
mean,
talked about that today.
I know. Well, I mean,
seminar.
certainly, but you don't want to make people afraid, because I can't imagine that these politicians aren't going to do tinker.
Right. But the
Right.
thing is, we know what the laws are for the next 2 years
Right,
for
and
sure.
that's why
So use those
Take advantage of them. Mm-hmm. Right? Okay, and then we
Yep.
have Bob. Hi, Bob.
Hi, Esther. Wanted to ask a question, if I may. As
Yeah.
I get older, I realize how little income I really have for the last part of my life. I can't help but notice people standing on the side of the road with the tin cup. I have a question. I do notice people at yard sales and other people that sell some very unique items, which I am in a position to do if I choose to do that. Am I responsible to claim that as an income? Do I need permits if I decided to become a sidewalk vendor, so to speak, to peddle some of my wares as the artists do? Or is that something that is permittable under the law as far as you know?
Okay, so anytime you make money, is potentially taxable unless it's specifically tax exempt. If you're selling items, personal items that you have at a loss, then it's tax-free because the loss is not deductible. If, however, you're selling collectibles or other items at a gain and you're in the business of trying to make money, then that's what's called gig income, and it's taxable, and you would file a Schedule C. You don't have to get licensed for doing that. Like if you have a garage sale, you don't need to get licensed for that. You might want to become an LLC to protect yourself, to make sure that if anybody coming over to your house, if they tripped and fell or went in a manhole, that they're not going to sue you. But you certainly, I mean, becoming self-employed is a wonderful thing to do. But again, if you're selling like a kitchen chair that you no longer use, and you paid $80 for the chair and you're selling it for $20, you're selling it at a loss, and it's personal, it's not deductible and not taxable. Okay, the rub comes in is if you're taking third party pays, right, you guys?
Right. So if you take Venmo, stuff like that, eBay, PayPal, right,
then they're going to send you a 1099-K form. The 1099-K form just lists all the money that you got. The IRS doesn't know if it was sold at a loss and it was a personal asset. And in that case, you would put the sale that from the 1099-K form on Schedule 1, Box 1A, line 8Z, and you would offset that in Schedule 1, Box 1A, Part 2, line 24Z.
Yeah, and then
How's
B
that?
plus D
Very
plus
good.
J.
And so one offsets the other. So it becomes complicated from a tax standpoint, but it would be a great way to make some extra income.
No wonders my heart is in my throat. I would just follow up with one point. Whatever I'm going to sell, I would have to do through the vendor that I have my phone service with. And I will just tell you how unique some of this gets. I have some video that I took on Sunday when I was downtown at the reservation of the Sun Pulsing. And I've got 3 videos that are 39 and 40 seconds long, in which everybody I show is just... they're jaw drops. So some very unique stuff. But again, as I get older...
Now you see there, Bob, you have no cost. I mean, you have very low cost anyway. We're just getting downtown to take the film. So anything you get would be taxable because there's very low cost.
We've talked about this, and I understand it well. But like I say, my choice is now: do I put up a tin cup like I see them doing on the side of the road as I get older, or do I get a little inventive on some of this?
I think getting inventive makes you younger.
I like that idea.
You know, it makes you younger because it makes you go out and do stuff. Because my mom used to have this magnet on her refrigerator that said, "If you rest, then you rust." And I think that's true. So good luck.
I think he's got a
Hey,
good
Bob,
plan.
and if you need any help, give us a jingle, right?
Yep,
Right.
yep.
All right. I'm Esther Gullius, 8030930, 8030930, star 930 on a cell phone. Yeah, you're only as old as you feel. Oh, my gosh. Maybe that's not good. Old as you think. All right, let's see. We got some text here.
Yep. My father passed away and left a traditional IRA. Am I required to take a required minimum distribution? I'm 12 to 15 years from retirement.
Okay, well, explain the whole thing. You guys are excellent at explaining why they have to take money out.
Right.
Because
well,
it's an inherited IRA.
Right. As if Dad just passed away this year and he already took his RMD, you're good for 2023. But starting in 2024, yes, you're required to take out a minimum distribution because Dad was, and you have to take it all out within 10 years.
Right.
So an inherited IRA, you have 10 years to take all the money out. So unfortunately, we got to see if Dad did, and if he didn't, you do for this year, but definitely starting in 2024 for sure.
Yeah,
you would have to.
And it has nothing to do with, regrettably, when she or he's ready to retire.
Correct.
Yeah.
Right, because if it were an uninherited IRA, then you go to the 73 age 73 or older for the required minimum distribution. But once it's an inherited IRA, it has a whole new set of rules.
Yes.
Okay?
Yep.
Okay. And then we got Joe. Hey, Mr. Joe, how can we help you?
On the cancer insurance policy, if you receive benefits, do you have to claim that on your taxes?
They're paying you?
Are they paying your medical or are they paying you some?
It's an Aflac policy where it's a cancer policy I took out years ago, and now I'm claiming on it. They're paying me. Do I need to claim that?
But you paid the premiums, right?
Yes, yes.
So that shouldn't be taxable.
No.
Okay.
Not
So
taxable.
that, it's interesting. Whenever somebody has a wage continuance policy, if it was a wage continuance policy, then it would be taxable. But sometimes you think some of these obscure policies that you think you'd never need, if you do need them, what a godsend,
Yep.
Correct.
Yeah. So yeah, it's not wage continuance, right, Joe?
No.
No.
Okay. Yeah. Then it should not be taxable.
Great. Thank you very much.
Okay.
Thank you.
You're
Great
very
Good
question.
welcome.
luck with everything.
That's right. And the other thing is, if you have life insurance and you have a situation where your life is in jeopardy, you can also take out money from your life insurance policy tax-free as well, if you should need. Because when you're well, it's great, and when you're sick, it just costs a fortune. And so any port in a storm. So that's another thing that you can do too.
Right.
So, okay. I'm Esther Gullius, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. And we got Lynn. You think we can do this quick?
Yeah, and then-
Sure.
Well, what's Lynn got to say?
We got Lynn.
Hi, I'm just calling to find out what home improvements are deductible in 2023 on my taxes.
All right, it's not home improvements, it's all energy conservation.
Yep,
Okay?
such
and
as-
it's not like, I don't care if you put granite in your kitchen, it's not going to work, or brand new appliances, that doesn't work either. It's got to be something to basically make your home more energy efficient,
New
just like it
windows.
was in the past. Again, Energy Star, and you, if you're doing like a geothermal heat pump, that would be 30% up to $2,000 in credits, and just doors, windows, furnace, hot water tank, insulation that are Energy Star, 30%, maximum $1,200 per year. So you actually can save $3,200 per year every year, as long as you qualify.
Lynn, what are you guys doing?
Windows?
Oh, you're good.
Yeah, Windows. So the limit there's going to be $650 on Windows. So you might be wiser to do some Windows this fall and some Windows in January. So then you'll get $650 times 2 or $1,300. Otherwise, if you did $12,000 in Windows now, you're only going to get $650
So 650 is the maximum 30%.
each year. Yeah.
Right. That's my
Okay.
that's my goal. Thank
All
you.
right.
Good
Thank
planning.
you, Lynn. Thanks for calling. All right, I'm Esther Gullies, the tax lady from EG Tax, 8030930, 8030930, star 930 on the cell phone, and you can text us at 716-8030930. We're going to take a short break for news. We'll be back on the other side.
We are family. I got all my sisters with
Hey, all my family members, thanks for listening. I'm Esther Gullius, the tax lady from EG Tax. We want to help, and that's what this is all about. That's what this show is all about. 8030930, 8030930, star 930 on a cell phone. I got Tiffany Fabian, Christopher Fabian here in studio with me, and we want to help you. I wanted to, before I get off track here and I don't tell people, the current interest rate, BMO Bank is doing a 5-year 5.25% CD. And I was with my girlfriend last night, and she said, but I can get 5% for 9 months. And I said, oh, don't you want to get 5.25 for 5 years? And she said, well, but maybe that it kind of scares me, because what if I need the money? Remember, it's always your money. And if, let's say she needed $20,000, most banks will allow you, as long as the preponderance of the money still in the CD, they'll only charge you a penalty on that one amount of money that you take out. And so most of your money will still be tied up. And but the other thing is, in 9 months, what if interest rates go down, right? Or in a year from now? She'd have it tied up for 5 years, so that's something to think about. But for those of you that are faint of heart, there's Everbank is doing a 5.15% money market account. So that's not tied up at all. But then again, you don't know how long it'll be at that rate. So something to think about. You know, the thing is, if you had $100,000 in a local bank here at a 0.5% interest, because you don't want to mess around with it, all you're going to get is $500. But if you put that in the 5.25% CD over 5 years, you get $23,750 in interest.
Wow.
I mean, that's quite a difference.
Yep.
Quite a difference. Okay, we got a big text.
We
right?
got a big text. The text says, good afternoon, folks. This may be a stupid question, but I simply don't know, and I'm too lazy to look it up. And Google, and I get possible correct answers, but why is there a mandatory distribution that you have to take out? Like, how does an IRA work that way?
Okay, so to put it simply, they have waited. They gave you the tax deduction when you put the money in, and it's been growing tax deferred ever since. And the federal government wants your money.
Correct.
And so it used to be 70 and a half. Then it went to 72. Now it's at 73 that you have to start taking it out because they would really like your money. They've been waiting all this time for your money.
They want to tax you on the money.
So the federal government can use the cash, and that's why there's required minimum distributions,
Correct.
Yep.
right?
Yep.
Yeah. Yeah.
All right, and why don't we go to Pat?
Hi, Esther.
Hi, Pat. How can we help you?
I don't know if this is up your realm, but it's about Medicare.
Yeah.
On Facebook, they keep showing if you're over 64 and you answer these 3 questions, you would get a debit card for like over $1,000 to pay for groceries and different bills. I pressed on it, and they're asking your age, okay. Then they want your name, your email, your address, and all that stuff. So I didn't go any further because I don't know if it's a scam.
I
or
know,
if it's,
and
individual.
I'm going to tell you, if you don't know who you're dealing with, and you're giving personal information over the internet, you should not do it.
Yeah, they're
Pat-
sorry.
Oh,
Jeff.
one, Chris.
Pat, what is it that they're saying that you get extra money in your check or in
No,
your
not
in your account every month?
They
Is
give
that-
her they give you a debit card.
Debit card for over. This is every single day this is on, and it's always different
Yeah,
ways.
I've seen that. If you're a lower income person, you can get money back in your account for the amount that you pay for your Medicare. If you're are you a lower income person?
I don't know what they consider lower.
Very low. I
Yeah.
mean, your best bet
Call
would.
me on Monday and I'll vet it for you. I'm
Well, no,
familiar
I know,
with
but
that.
I was going to say that
Oh, yeah,
she could
that's
call the
true.
financial guys, health insurance people,
Right, and they'll
and
know
that's
if it's
what they
real.
deal with.
But you want to know why they keep doing this every day, Pat? Because once you click on it, then there is something behind the scenes on the internet that says, Pat likes this. Keep sending these things to Pat because she's going to click on it, and maybe if we're lucky, she's going to fill out the information and we can seize her bank account. So there is, whenever you do anything online, behind the scenes, it's figuring out what you like. And so
that
once
I
you
am-
click on that, that's what they do.
I just didn't know if this was legitimate for Medicare or if it's
Yeah, no, I wouldn't click on it.
or call me on Monday or Tuesday.
If you call 632-7886, 632-7886, that's us. You know us because we will take care of you. So and we'll go to the financial guys and find out. I happen to know that there is some special things that Medicare is giving to people who are low income, and we'll find out how it happens so that you know who you're dealing with. Don't ever do it on the internet unless you absolutely know that you contacted them, not them contacting you.
right. The other question is they keep saying Medicare is paying for the new liposuction. If you
Yeah,
see
sure.
that-
Well, if they do, let me know.
They're gonna liposuction your money.
Like liposuction all of me.
Could you ask the financial guys, and then when I call you, maybe you'll have an answer about that?
Yeah. Call me
Yeah.
on Monday, Tiffany.
Yeah, we'll
Fabian.
help you.
Okay, thank you very much.
Thank you, Pat.
Okay,
Bye.
bye.
I'm telling you. Sometimes I look at some of these things and I think to myself, is it a scam or isn't it a scam? But the minute you click on it, they're going to keep sending the stuff to you. So sometimes I think in the privacy of my own house, I might be talking on the phone to Tiffany, and I'll say something like, "Gee, I'd like a new pen," and all of a sudden they start sending me pen ads.
I know.
But anyway, okay. Who else we got?
We
Kate?
got a text in. It says, the first one says, thank you. That's what I thought. I'm going back to one of the IRA questions. Then it says, what is considered a high deductible to be eligible to have an HSA? And that is a single person is $1,600 this year, and a family plan is $3,200. So
that has to
that's-
be the amount of your deductible.
That's your deductible. Yes. Yes.
And you have to be under the age of 65,
Correct.
because once you're 65, then you got to go on Medicare.
Yepers.
Right. Okay. And do we have any? And then we got Kay.
Okay.
Yep.
Hey, Kay.
Hi. I have two quick questions. If you're selling on eBay and you make maybe $3,000, shouldn't you be able to deduct the postage costs for those
Absolutely.
items when you sell them?
And it's really interesting because you're leading me right into what I was going to talk about. Starting this year, if you have third-party pays, and eBay would be that, they're going to send you a 1099-K form indicating how much you got from them for eBay sales. That you're going to put on a Schedule C. On your Schedule C, you're going to report all your gross income from that eBay plus all the other self-employment things that you might have had selling items online, and you come up with a total sales. You reduce that by the cost of the product in order for you to sell it. So if you're selling widgets, the cost of the widgets that you sold is an expense, plus your postage and your eBay fees, and maybe you
Part
have
of your
a
internet.
place in your home, office and home, your internet, a computer if you bought it, travel if you had to go to the post office to drop off things. Everything that costs you money that's ordinary and necessary reduces the gross amount of sales that you had, so that what's left, bottom line, is what's taxable.
And then Kay, you had a second question.
Yeah. Since we have such high inflation, shouldn't these lower income people, shouldn't that be, instead of 12,000, shouldn't it be more like 15, 16,000? Shouldn't that be adjusted?
You mean the standard deduction?
Well, they consider you low income if you're $12,000 or something.
Oh, you're talking the Medicare, Medicaid limits?
Well, for any people that are low income, yeah. What the federal government considers low income people, shouldn't that be adjusted?
I think so.
Well, here's the thing. It all depends on what you're talking about. There's different levels. Like, for instance, the earned income credit, you can get if you have children and you have wages, and you qualify. Your income can be $60,000, and they consider that low income. It all depends on what specific thing you're talking about. The standard deduction for somebody over 65 this year is like $15,000 because you're a single person. Two people would be $30,500. So that's before you have to pay taxes. So it's, that was something you should take up with your representative or senator. That you think
it
that
looks
that's
like they have raised those. That they have adjusted it.
Yeah,
well, they adjusted it for inflation. So this year,
they
the
do
big one was
adjust
last year.
Medicaid every year, and then in New York State, for health insurance purposes, because how many people are on it, they even make it even bigger. So there's different things qualify, different income levels for what you're looking for.
Right.
Okay, well, knowing the federal government, that's a miracle.
Yeah. Yeah.
Thank you.
Thanks.
All right, thank you, dear. Okay, I wanted to talk about the 1099-K form. You really got to start thinking about it now, because if you're somebody that's gotten third-party pays, whether it's whether you're a kid in college and your mom and dad have been Venmoing you money, you're going to get a 1099K. If you sold stuff on eBay, you're going to get a 1099K if it exceeds $600. If you sold things at a loss through Venmo or eBay, you're still going to get that form. So you want to make sure that you know where it goes.
Yeah,
So
I mean, it's even you pay for a family trip and everybody Venmos you the money, and
you're going to get a 1099K.
You're going to get 1099K.
So
for
that's
that.
why if it's income, if it's on the 1099K and it's not taxable, it goes on Schedule 1, Box 1A, line 8Z. And then you offset and you say that personal, just reimbursement for personal expenses, and the offset is on Schedule 1, Part 2, Box 1, line 24Z, and the one offsets the other. So, but if you say, oh my gosh, I just don't know what to do with this, and you ignore it, you're going to get a bill.
Yep, they'll catch up with you. And
I mean, if you take a look at the IRS's website, one of the first things they're talking about is the Schedule 1099K.
And just like that, how they're going to send you a letter, just like today, tomorrow, if they send you a letter, don't just pay it. Make sure that we take a look at it.
Right,
Yeah.
because if you don't know how to handle it, like for instance, if it's rents, it's got to go on a Schedule E. If it is something sold at a gain, then it has to go on Form 8949 and on the Schedule D. So if it's hobby income, then it would be on the Schedule 1 again with the offset. So it all depends on what is the nature of the income, but it's up to you to prove it. So you want to make sure that you, before it starts, we start the Christmas season and you're out doing holiday stuff, and then before you know it, it's tax season, and you go, oh, I didn't even know what to do. Do it now.
Yep.
You know, allocate what all your expenses are. Figure out what all your expenses are, because you're going to need them.
That's right. That's
Right?
right. And
Yep.
a lot of times, like Chris said, it's just money that you got from family members. Because
By the way,
for the
and
trip.
if you get the 1099K and it's incorrect, go back to the person that issued the 1099K form and say, this is wrong. And when we went to the IRS seminar, they just all laughed because they said that nobody would correct them.
Yeah.
But that's what you're supposed to do. All right. We're going to take a short break. I'm Esther Gullius, the tax lady. Talk to you on the other side.
We are family. I got all my sisters with me.
Okay, my family, this is Esther Gullius, the tax lady from EG Tax. 8030930, 8030930, star 930 on a cell phone. You can text us at 716-8030930, but I bet you Tiff would like it to be less wordy. Would you think?
Yeah, this one says, my father died in 2006 and I inherited an IRA. I've been taking the minimum required distributions ever since. There's approximately 100K remaining. I haven't heard today that one is
I
10.
heard earlier.
I heard earlier today that one is 10 years to take out residual money. Should my account be at zero? Chris does my return. Thank you, Gary.
Okay, that I'm glad we have this, because this is a recent change
Yeah.
in the tax law. Before that, it was based upon the actuarial tables and your life expectancy. That was, what, 2 years ago, right? They changed this?
Yep, 2020, I believe. Yeah.
Right. So if you had been doing this under the old law, you're good to go. So not to worry. Great question.
Very good question.
Great,
Yeah,
great
good
question.
listening.
But if you get an inherited IRA now under the, I mean, they can't keep it the same for 2 years.
No, and it gets very confusing too, because if you're less than a 10-year age difference from the person who passed away, then it goes back to the old law.
The actuarials, yep.
Yep. So it depends on who died and all that fun stuff.
And I know, again, 8030930, 8030930, star 930 on a cell phone. I wanted to talk about gifting because it is the holidays. You can gift up to $17,000 per person per year without having to file a gift tax return, right?
That's right.
And over and above that, for education and Medicare, medical expenses. If you're somebody that has a large estate and you really start tax planning and you had 10 children and grandchildren that you wanted to give $17,000 to, and you give away $170,000, you might think, wow, why would somebody do that? Because if they have a large estate, they save $68,000 in estate taxes by giving it away.
Yeah.
So, you know,
And-
and so their family has it, and they save 68,000. Of course, they're dead, so they don't know that they save 68,000, but it makes them feel good for planning.
Right.
right.
I mean, I had a gentleman at the Ready Set Retire seminar. He has a fund he doesn't like. It's very aggravating to him. And he wanted to start doing something with it. He wanted to get rid of it. And I was talking about beneficiaries, children. And he goes, well, there's 5 people I could give it to. And I figured it out where if he gave, there's, a little bit this year, and then in 2 months, because what's in 2
That's
months?
right.
New year.
Next year.
Next year, he could get it all done within 2 months and not file that
34,000.
stupid gift tax return.
Right, absolutely.
Should we go to Gina or John?
Well, okay. Anyway, so think about gifting. You don't have to even gift wrap. All right, so we'll go to line 1. We'll go to Gina. Hi, Gina.
Hi. Okay, so my question is, we own 3 properties, me and my husband needs a new truck. So if he's going to buy a new truck, and he, of course, uses them for these properties, they're LLCs. Am I allowed to write that off?
Well, it would be, yes, you can write off a business asset, all right? Yes, that's the first thing. However, it's subject to limitations. So just because you bought a truck that you said your husband's using it for 3 properties, how many of the properties are investment?
They're all 3 investment properties. We own 3
All right.
doubles.
And
So
then
is this the only vehicle he uses for those properties?
Yes, it'll be the only one.
And does he use the vehicle personally as well?
Not usually. To go to work, he also has a job. But other
right.
than that,
All right, so
yeah, other than that, not much.
all right, so let's say his commuting is 10,000 miles a year, and he put 20,000 total miles on the truck. So that would mean 50% of the truck is eligible for special depreciation, because it's the business usage of the truck that would allow you to either take the standard mileage rate or depreciation.
Got it. Now, what if we're going to pay cash for it?
same.
Makes no difference. Same, whether you borrow the money or whether you pay cash for it, you don't get any bigger benefit, except for the fact you don't have to pay 8% interest.
Okay, because I know right now we do write off his miles
Right.
for his work.
And so you get to do it again.
Yeah, you have to percentage out the personal usage to business usage, and the business usage
Yeah.
would be the write-off.
And then
do that all
if
the
you've and if you've done this before, if you depreciated the last truck, then you have to recapture that, and it's going to be a taxable event. I would suggest you give us a jingle so we can get you all squared away. There's no charge, so if you want to give us a call, 632-7886 on Monday, we're happy to help you.
Okay, thank you.
Thank you, dear. Bye-bye. All right, and then we have
John.
John. Hey, John.
Hi.
Hi.
My question has to do with long-term care insurance premiums, as
Okay.
far as they're being deductible as a charitable deduction. I know they are, but they change. The amount of the deduction is it changes, the allowable amount changes from year to year. And
Well,
I'm
John-
wondering, what's it going to be for this
John,
year?
Good
John,
question.
it's medical, not charity.
Yeah,
I think
excuse
you
me,
know
yeah,
that.
medical, I'm sorry.
Okay, all right. And so medical is based upon there is a floor every year that's a percentage to your total income. That's why it changes every year. And there's also a floor that they limit as to how much of your long-term care insurance is going to be deductible based upon your age. So those are the only 2 things that would change. And of course, on the state of New York, it's not only just like on the federal, it's a itemized deduction, but on New York State, it's a carry forward
Yeah.
New York
credit.
State, I don't even have. It
Enough
just
to
wipes
itemize.
my tax liability off completely.
Yeah,
Right.
I think
The
Chris
federal,
is.
that's a whole
But the
different story.
credit carries
I think
forward on
Chris-
New York, so you always want to make sure you keep
Oh, yes,
track of
I
that.
carry that
Yep,
forward.
yep.
Smart. And I think Chris is trying to grab the figure for you, John.
You mean the long-term care?
Yeah, he's
deduction,
trying.
right?
Chris is trying to grab the figure. I was talking to a client today at the seminar about long-term care because she's worried about her or her husband going into a nursing home and depleting all of her assets. And so, very smart of you that you have long-term care. Very.
I've had it for years now.
Yeah, very,
Right.
very
Well,
wise.
so if your income were 100,000, they would reduce your medical by 7.5%, which would be 7,500. But your long-term care credit, I'm looking right here.
How old are you there, John?
I'm oh golly, I'm 87.
Ooh, okay. So you
All right, so you
get
get the maximum.
$5,960 as a part of your
Young
medical
guy.
cost.
How much?
5,960.
5,960.
Yep.
No, it'd be similar for the wife because she's 87 years old.
Exactly.
Right.
Yep.
Right.
5,960.
Yep.
Correct.
If you pay up to that or more than that, it caps it at that
Right.
figure.
We pay more than that, yes.
Yep.
Yeah. So 11,920 for the two of you.
Got it. Thank you very much.
You're welcome, John.
question.
Have a great day.
Very good planning.
Yep, very good planning. Okay, couple other things. If you're an Uber driver, if you're a Instacart driver, make sure you take advantage of all those deductions too, because even though they send you the form at the end of the year saying how much you got paid, you have a lot of expenses such as mileage, commissions, tolls, supplies, cell phone, computer use for business, navigational software, office and home if you needed it, appointment software, office equipment, all of those kind of things are also deductible. And if you're doing a home equity credit line because you want to get rid of your credit card
Wait,
debt.
can I say something before you get to
Yes,
that?
sir. Yes, sir.
I know in the news there's the big thing that Uber is trying to settle a lawsuit and drivers are going to get this money back. If this is what it is fees that they charged drivers that were written off against taxable income. So this money you're going to be getting from this lawsuit would be taxable to you as part of your self-employment. So
Right.
be careful out there. If you do get the
Absolutely.
money, keep money aside.
Absolutely. And again, if you had some, I had a second text this morning. I got extra income. Should we do estimates? Yeah, give us a call. You still have time to do your fourth quarter estimated payment, which is due January 15th of 2024, to avoid penalties if that's the situation.
And then I want to make sure that we sneak in there Happy Veterans Day. There is nothing more important. Thank you for our vets out there.
That's true.
Yeah.
Absolutely. Being patriotic doesn't seem to be the norm with everybody marching on.
But where would we be without them?
And then Esther, on
Yep.
Monday, are you going to watch the Bills game?
Are you kidding me? No. Oh my God! If I ever didn't want to watch them, it's now. I don't know what's happened to them. Let's not get me going on that. But during the week, if the subject of taxes and I wanted to talk about home equity credit lines. If you're paying a bunch of money and interest on your credit cards and you have equity in your house and you're taking out a home equity credit line at like 8%, that's not deductible. It'll save you a lot of interest, but it's not deductible as an itemized deduction because only home equity credit lines to improve your home, your personal residence are going to be deductible. If you need us during the week, go to egtax.com. Call us at our corporate headquarters. We want to help you. Have a great weekend. Thanks for listening. Bye-bye.